Hi, very good morning to all of you. This is Vidya from ITIS Capital, and I'm glad to welcome you all to our Q1 Investor Call 2024. Thank you for taking the time to be part of our Saturday call. At this time, all the participants will be in listen-only mode, and then after a brief presentation by our founder and fund manager, Mr. Naveen Chandramohan, we will have a Q&A session. Today, Naveen would walk us through our portfolio performance in the last quarter and discuss his views on the market. Let us hear it from him. Over to you, Naveen.
Good morning, everyone, and thanks, Vidya. Um, Over the last 3 months, as market continues to reach new highs, not just in India but globally, the often asked question that I'm hearing is, are the levels too high? And what do we do? While this question is getting asked, if you look at the flows, especially from domestics, it continues to increase. In fact, just looking at the SIP flows at roughly around $3.3 billion per month, this is the highest it's ever been, and the flows don't seem to be abating. So, one of the things that when this question gets asked, I feel is when you look at answering this question, it does help to change the frame of reference around what exactly are we going through. And typically, internally, when we evaluate risk, we like to position countries and economies in one of these four quadrants just to understand what is happening. And I'll explain to you the context behind how it would help from a portfolio positioning perspective. Now, it's our belief that India is in a certain quadrant where prices seem to be increasing and economic activity seems to be increasing, which is what we call is an inflationary boom. Now, if you've attended my last 2 to 3 calls, I've been speaking about the fact that we are in an inflationary environment and not in a deflationary environment. We are in an environment where I don't see the odds of central banks cutting rates in an aggressive scenario. And it goes back to why I'm saying that. Now, just to put this into context, if you look at US in the last 10 years between 2010 to 2020, they were in a disinflationary boom environment. And now, if you superimpose what that means, prices drop, interest rates drop, and then you can superimpose the kind of positioning and what sectors did well at that point of time versus the kind of environment that we are in today and what we expect to do well. So, in an inflationary environment, obviously, no one is ready for inflation. If you hear commentary, you will not look at it. The data points do suggest that, but the commentary still speaks about central banks evaluating rate cuts, which I would be very surprised if we get that. So, generally, it's very hard to pre-position for inflation. But when you look at the core underlying structure of the economy, that is what it looks like to me. And that is how we are positioning our portfolios at ITIS. And I'll tell you the implications of that. In terms of how our economy is, there are three drivers around the economy. One is what we call as earnings, and we reflect that as shown in the first chart by what is called the market cap to GDP ratio. So this ratio has been used by multiple global investors. People say 80% is cheap, 120% is the higher end of the range. And as you can see, we are at 128%, which effectively tells you valuations are no longer cheap. So whatever I'm talking about in terms of earnings is reasonably priced in because pretty much everyone globally is aware of the fact that India is a certain bright lone star in terms of GDP growth. So there are three drivers for this. One is strong GDP growth, which we are already getting. Second is reflected in the valuations, which effectively means valuations are not cheap. And third, that's what you're seeing in terms of market cap positioning as well. One of the interesting things when we keep talking about India, what we lose perspective of is we are in a global bull market. US is at an all-time high, both from a valuation as well as from a price perspective. DAX, UK FTSE, Japan, all of these indices are at an all-time high. So it's not just that India is at an all-time high and everyone needs to discuss, will the price fall or will the price go up? It's important to contextualize this and then move on into our argument. So effectively, in this kind of an environment, it's even more important to look at earnings growth. So one of the things that I made is the fact that we are in an inflationary environment. Now, that's a certain viewpoint. What we do internally is to ensure that we can corroborate the data points on the ground from a micro perspective to ensure that what we are talking about from a top-down perspective aligns. The way we do that is to look at each sector and where is the growth coming through. Now, for us, when whatever view that we have of the world, if it doesn't translate into growth, we will acknowledge that the world is transitioning, which means we have to realign our view. So if you look at our portfolios and if you basically superimpose that with an inflationary boom, you will see we are overweight cap goods, manufacturing, power, infrastructure, and auto. And the last one over the last 3 to 4 months where we've been increasing our exposure being pharma. So why are we overweight these 5 to 6 sectors? And why are we underweight consensus, which is banking and consumer? So now if you look at earnings growth in the last 1 year, there are two aspects of a portfolio company that is non-negotiable to us. One is, do we get earnings growth? Second, can our companies expand margins? If not, at least protect margins. We don't want our companies growing at the cost of margins. And if we can superimpose this and say that we are not overpaying to own this growth, which is the qualitative aspect, then you have a reasonably robust portfolio that you can construct. So today, when you look at the 5 sectors that I spoke to you about, you will see that these sectors are growing at roughly between 15 to 24% on average, and their margins are expanding. The one sector which is still showing degrowth is consumer, where the volume growth is still not coming through. The counter consensus view that we have been having for the last 3 to 4 quarters that we continue to maintain is our underweight on banking. Now, if you look at the growth for the banking industry per se, it's fairly robust. But if you look at why are we underweight, I'll cover that in the later part of the presentation, where I'll take you through some data, what we are seeing on the ground, and why do we believe that we will not get hurt even if we are wrong. So one of the important things about how we think through portfolios is how do we ensure we don't get hurt when we are wrong, and how do we ensure that we have maximum upside capture when we are right. So what does all this mean to the ITIS portfolio? You will see this in terms of numbers, where we are significantly overweight auto, both in the form of 4-wheeler and 2-wheeler, alongside, because 2-wheeler is an exposure that we've been building in the last few months, and auto ANGs as well, which is something that we've been carrying for the good part of 22, 23, and even 24, which we continue to be overweight. The other sectors that I spoke to you about where we are overweight is reflected in the numbers here. And what is also clear is where we are underweight, which is IT, banks, and consumer. And where we are overweight is power, cap goods, manufacturing, pharma, and auto. So like I said, there are 2 core characteristics that we look for. One is earnings growth and second is margin expansion. Now, if you look at the portfolio, at a portfolio level, our earnings growth is roughly around 19.2% on a year-on-year basis. The way we reflect margins, we look at it both from a gross level, which is basically just the revenue minus cost of goods sold. And we look at it from a bottom line perspective as well. How is it getting translated into at an EBITDA level? So if you look at our portfolio shape over the last 7 years, roughly in 2017, our gross margins at a portfolio level is 54.5. Today, that same number is 59.3, which is what I call as prices go up, which is the environment that we are in, we want the portfolio's margin profile to also increase. Second thing, is that translating into an EBITDA margin? Today, that EBITDA margin is roughly around 18.4%, which translates into a very strong return on capital. Why does all these margin profile matter to you? The reason it should matter is because what you want is growth which is accretive and growth that translates into a strong return on capital, which is roughly greater than 1.5 times cost of capital. Now, when you superimpose these two into valuation, which is the last subject that everyone talks about, how do we think about this? Valuation is always a range for us. So, for example, today our 1 year forward multiple that we are owning our portfolio companies constructed is roughly around 26 and a half. We are owning the earnings at around 19.2. So that roughly translates into a PEG of around 1.55. Typically, what we look at doing is as our portfolio PEG effectively begins to go closer to 2, we would like to maintain higher than average cash. And as it drops closer to 1, we like to increase our particular equity exposure. So effectively, what we are saying is how much are we paying up against the earnings growth that we are getting, and is that number reasonable? Very rarely in your cycle will you get a PEG less than 1 at a portfolio level. It's happened twice in the last 7 years of us running, and that's where we will fully get deployed and fully get concentrated. Now, in a market like today, again, in the last two quarters, I've been speaking about shifting risk more into large caps, not because of the fact that large caps means safety. That's not the reason. The reason is today's environment, more than ever, liquidity matters a lot for us. And the environment that we are in, the liquidity looks like it is there, but it can go away very easily depending on the flows. And 2024 is a year where I have been talking about increased volatility. We've not seen it yet. We've seen first signs of it, but I wouldn't call that volatility yet. Now, when I have spoken about positioning for inflationary boom, the natural question that I ask myself is why do we still maintain cash? Because in an inflationary boom, cyclicals, metals, auto, cap goods, power, all of these should continue to do well. So why not just go fully deploy your capital? I'll answer that question, but before that, the weighted average market cap of our portfolio is roughly around 1.35 lakh crores, and which is why I call this more of a large to mid cap portfolio. Before I answer a few questions that I raised myself, I want to speak about position sizing and our framework. One of the things that I have always maintained is concentration doesn't mean higher returns, right? In fact, when you study the mutual fund industry over the last 4 or 5 years, most of them have done really well, even after owning 80, 90, 120, and 150 stocks. Now, I'm not advocating that, but I'm saying that just because you do 12 businesses or 15 businesses, it doesn't give you the right to outperform. In fact, it can give you the right to underperform even if you get one wrong. So the important thing around concentration is we like to do it only when we have valuations under our control in terms of downside protection. We also like to do it when we have earnings growth supporting this particular framework. Today, we have earnings growth which are strong, but valuation is, like I said, in the median end of the range. It is not cheap. In this kind of a market, we don't want to be concentrating. And hence, when you look at our portfolio, you will see roughly 33 to 35 investments in our portfolio, because across the board, you would have seen us taking starter positions. Now, what should you expect along the way? Now, today, as we start, today's snapshot will look like 34 investments. Now, over the next 3 to 4 quarters, we will see certain businesses not executing basis our plan. I'll give you an example. Over the last 3 months, we started buying a starter position in a company where we are only seeing initial signs of growth, but the category is not growing, which is consumer. The company that I'm referring to is Marico, but where we have only taken a 3% starter position. Now, why have we taken a 3% starter position is because over the last 3 years, Marico's volume growth has been 2.5%. But over the last 5 quarters, they have expanded their margins. This margin expansion has come on the back of operating leverage and better raw material input inflation, them being able to manage this. Over the last 5 quarters, they've also expanded their category by making a few inorganic acquisitions. Now, for the first time, we are seeing fundamental data points on the ground to suggest volume growth could come back in the next 2 quarters. Now, rural economy has also been hurt over the last 3 years, and we believe that there is a chance for it to mean revert. And one of the beneficiaries could be Marico if this happens. Now, for this to actually translate into concrete evidence on the ground, we need to be waiting at least 2 to 3 quarters. And if data suggests that happens, we might choose to upsize. But the same reversal, if this doesn't happen, we might choose to exit. So what this means is this 34 will have 5 to 6 businesses where the thesis may not play out as we expect it to. Those would be exits. Same way, there are few companies that we expect to see non-linear growth in because of the cycle that we are in and because of the entire inflationary environment that we are in. And as if we get that, and if the cycle positioning is right, you will see us upsizing more in those companies. So concentration to us gets built over time rather than on day one. And the second reason concentration gets built is through gains, where we are not looking to sell out of those businesses which are compounding over time. We want to be holding on to them. And that's how concentration gets built in our minds, rather than saying today's environment, this fund manager believes that he has great high conviction and go and load up the boat on a particular business. It's nice when it works out. When it doesn't work out, which every manager goes through cycles, the drawdowns will be significant. And that is something we want to be avoiding. So if you look at our portfolio, you will see the same thing can be seen in greater detail in the letter that I had shared. We've broken down all the companies, our portfolio exposure, why we have certain sectors, why are we overweight there, and what do we expect. So I'm not looking at covering them today at a granular level, but if there are any questions, we'll be able to address them in the Q&A session. So the next question, there are two questions I would like to address, because before I open the floor to questions, why do we own cash when we are optimistic? Now, in order to explain this and where we are in a cycle, I need to go into slight amount of history such that I can explain some data points. Now, what does this table tell you? You take any sector in India, it doesn't matter which sector, I'm not concerned. Right from a cyclical sector to a consumer sector, there has been something that has been happening in the last decade. Well, I'll explain what this means. So let's take cement, for example. Cement in 2010, the top 5 companies used to consolidate and own 35% of the market share. As of 1 year back, that same market share went up to 58. And if you've been following cement, two things have been happening. There have been capacity expansions coming up and being put by the larger players. Those people who've realized greenfield takes longer have gone and acquired capacity and expanded. And all of this has led to expansion. That is specifically on cement. And this numbers basically will transgress all the sectors. Now, what is the implication of this? The implication of this is between 10 and 22, you could have concentrated and it would not have hurt. The reason being, it was very clear who was gaining market share, and you could have gone and backed those top 2, 3 players who were gaining market share. You'll see the same thing with private sector banks because PSUs were losing market share. You'd see the same thing with telecom. You'd see the same thing with aviation. It was a trend across businesses. Now, going into COVID and coming out of it, corporate India had cleaned up its balance sheet, as a result of which tier 2 and tier 3 companies, which I call as typically tend to lever up significantly when they expand, also had cleaned up their balance sheet, and hence their ROEs began to expand. It's one of the reasons microcap index is the best performing index in India at the moment. But there are two other things that happened. One is capacity is coming in a significant way, not only from the large players this time, because that was not the characteristic last decade, from even the smaller players. So whether you take cement, whether you take steel, whether you take hospitals or aviation, the next 3-year capex that we expect is anywhere between 2 to 5 times the capex that we saw in the last 3 years, right? Sorry, last 5 years. So effectively, this capex, if it is coming only from the top 2 or 3 players, then it's a great sign to concentrate. But that's not what's happening because it's coming from across the board. The other argument that we keep hearing is consumer is not growing. Is it but India is a consumption driven economy, so consumption should just be bought. The argument against that and why I think we need to be careful is when you look at growth, growth in the consumption segment is happening. But that segment is happening from a broader base of companies in the unlisted space, which is what I'm saying, that concentration that you saw between 10 and 21 is not happening anymore. The broad base of competition is picking up. So if you look at unlisted, depending on, it doesn't matter what category I pick, the listed space is growing way lower than the unlisted space. Now, I have reasons to believe why that's the case, but the reason is not important because the reason is always post facto, right? So the question then you will have to ask is, if competition picks up across categories, at that time, if you go and concentrate, even if you get one drop, it will hurt. And if you look at this across spaces, for example, remove the top 100 companies, 2,700 companies, if you go and look at their net cash over the last 3 years, it's significantly improved. And the same thing over the last 5 years also. Due to capital inflation, today competition in the banking industry is also picked up. Today, SBI and Canara are lending competitively, if not better than the private sector banks, which didn't happen earlier. End of the day, the servicing is also gone up significantly. That again effectively means their balance sheets have improved. Number of property developers, as you can see, supply in the system is increasing significantly. What used to be a consolidated market between 17 to 21 is again diversified. All of this basically can put pricing pressure in terms of future earnings. And it's one of the reasons we don't want to be extremely aggressive in terms of going and saying we'll put all the 100 rupees to work on day one. And it's one of the reasons a month back, I had also written a note to all the clients, consider adding capital because we would want to see if we can use that capital over the next 3 to 5 months in an environment where I believe volatility could increase to we are not being contra for the sake of being contra here. If you study the history of the banking industry, right, we've never had a period of what we are going through today, where 2 consecutive years, deposit growth is actually lower than credit growth. Now, when you superimpose this statement with what I had spoken earlier, where earnings growth, which is what I call as loan book growth, is very robust. But when deposit growth doesn't catch up, effectively your NIMs begin to contract. NIMs begin to contract, which effectively means on a levered basis, your ROA and ROE begins to contract. So on the one side, you have valuations which are extremely attractive. I mean, if you look at the private sector banks, you're getting it at 15 to 16 PE multiple. Put it another way, you're getting it roughly between 2.5 to 2.6 price to book. So when you chart it out on a 10-year, it looks like it's the lowest it's ever been. So from a valuation perspective, I will make a case that banking is cheap. But the problem is, if ROAs continue to contract, which could happen over the next 3 to 4 quarters, there is no reason to believe even this valuation is cheap. So what I believe is, even if we get it wrong in terms of our positioning, I don't think we lose a lot. But if we get it right, I think we will avoid a drag. So far, it's been okay in terms of not positioning in banks, and we continue to believe that the pockets that I spoke to you about offer better and more visible earnings growth than banking industry, where growth is not a problem, ROA accretive growth is where the problem is. So broadly put all of this together, how do we think about our portfolio today? Like I said, we would be overweight in certain sectors which would benefit from an inflationary environment. You will see that we also own metals which are cyclical, and I have been speaking about metals having a decadal bull market this decade, and I continue to maintain that metals should do well. We are underweight on banking. We are selectively, from a bottom-up perspective, increasing rural consumption, but we are still underweight consumption as a theme. So this is broadly how I would look at explaining how we think about positioning. From what is our view on the market, why this argument on just discussing Nifty at an all-time high really doesn't get you anywhere. Instead, how do you position portfolios is a better way to think about risk. I do expect increased volatility. Positioning for that, we are increasing our positioning more so towards large and mid caps, and that reflects in the portfolio. Third, this is not a market we want to be concentrating in. We want to have a larger name portfolio, and that's what you'll see in all your portfolios. And fourth, we continue to maintain some level of cash going into the next 4 to 5 months.
Thank you, Naveen, for this wonderful presentation. Dear participants, you can now type in your questions in the Q&A section. The identity of participants are protected as the questions are only visible to the panelists. Naveen, I have a question here. Now, how do you see clients to invest at this point in the market?
So,
and what is your view on the impending elections?
Again, I mean, I'm not going to offer anything in terms of path breaking in terms of my view on elections. Today, I think any argument or any conversation that you have between two people, the conversation is either will the ruling party come with 400 or will it come with 320? And my belief is it will come on the lower end of the range, not 400, but I could be wrong. Net, I think market is already pricing in a higher than expected number. And if we get that, the market will be happy. FII flows will come back. If we get it closer to 320, then we should look at slightly higher volatility. But the reason I am looking at a slightly higher volatility is not so much elections, because we have 4 countries going through an elections this year, including US, UK, India, Taiwan just finished. And in an election year, governments will want to maintain prices. So end of the day, you have liquidity also balancing and supporting this. But at the same time, we've gone through 1.5 years of pretty much zero or no volatility, and which I think typically is not a very healthy sign for the markets. So purely from a risk reward perspective is where we are keeping some cash. How do we think we should invest? I mean, I'll tell you how we are positioned. We are positioned in an inflationary boom. We are positioned with some cash because of increased volatility. I don't know whether we'll get a correction or not. That's not what I'm calling for. But I think risk reward tells you that you should not be surprised with a correction. And hence, that's how we are positioning our portfolios. How should an investor invest theirs? Again, unless and until, that's a very personal decision. I cannot comment on that. For me, it's a question of how are we positioning our portfolios basis what we see on the ground.
Understood, Naveen. Thank you. How do you see the chemical sector, and what is your view on it?
So I think the chemical sector has gone through 2.5 years of what I call derating, primarily because chemical sector was priced like an FMCG sector, and this happens across cycles. Now today, the question becomes, can growth come back? Now, if you look at a low base of FY23, you might see year-on-year growth pick up this quarter. And hence, the market might get fairly excited looking at it as a mean reversion play. For me, I think the chemical sector's best period in terms of growth and margin expansion. Again, don't get me wrong, there are 2 levers. Just because you show growth doesn't mean it's a good sign. You need to show it along with margin expansion. I am making a statement that the best period is done, which effectively means there are select bottom-up stories that could look interesting rather than a sectoral play. So we are looking at select names, and we own maybe 2 names with a 2.5% exposure cumulatively. So will I overweight the sector because last year's growth was low and this year's can mean revert? I don't think so. If someone wants to make a trading play, because I see a lot of sell side analysts getting bullish on chemicals. And if you look at the March quarter export data as well, on a year-on-year basis, it is showing growth. Like I said, that growth should continue, but to me, it is mean reversion growth rather than structural growth. So will I overweight that sector? Answer is no.
Understood. Got it, Naveen. Naveen, what is your view on power? Will you continue to overweight that sector?
So, like I said, one of the sectors that I think is effectively most can surprise most people is power. In an inflationary environment, and if I believe in the quadrant that I took you back in, I think power does very well. Whether you study India between 2001 and 8, or you study US between 1971 and 79, all of those are inflationary boom cycles. So power should do very, very well in those. And within that, power is already done well, especially the ancillaries. We would like to stick to large caps in the product producers. That's where I think value capture can be the highest. And I think that you will continue to see that the demand actually outstrips the supply, because in order to put up greenfield, you might be able to put up solar and wind, but they are not sustainable sources of energy. They are all what you call additives into your core thermal capacity. But in order to put up thermal capacity from a greenfield perspective, typically it takes 36 months. And if your demand cycle continues to stay strong, then your deficit only continues to increase. So irrespective of how I think about the world today, whether you believe semiconductor manufacturing is to go up, data centers are going to go up. If you believe that chip manufacturing is to go up, no matter what sector most people are bullish on, the raw material for all of that continues to be power. So I continue to maintain that power can surprise on the upside.
A question related to this now. What is your insights on EVs and renewable energy?
So I think EV is here to stay from a 30-year process perspective, right? So end of the day, if you say that if I can take an extremely long-term view, EVs will do very well. But EVs are also going to go through cycles. And that cycles are going to go in the form of extreme fear and extreme greed. The easiest thing for you to look at what I mean by cycles is just pull up Tesla stock price in the last 7 years, and you'll see what I'm saying, because market will expect and superimpose the last 2 years growth. And then when that doesn't come, it will derate a particular business, because this is not going to be linear, because charging infrastructure, and there again, if you look at it, if someone has to be bullish on EV, someone has to be bullish on power again. So no matter how you look at it, you need the infrastructure layer to grow in tandem with the EV ecosystem, which generally infrastructure takes much longer to grow. So you will have to go through 2 to 3 cycles. So to just position and say that I want to own EVs and blindly invest, I'm not a big believer of that. But the EV ecosystem will enable certain auto amps. It will enable certain auto OEMs who are transitioning well. In a market like India, hybrid, according to me, works better, especially in the 4-wheeler space. EV would work better in the 2-wheeler space. And if you believe in the concept of quick commerce scaling well, there again, EV has implications. So I think specific pockets is what we would look at rather than just say invest in as a theme. Renewables, I think renewables, this is a statement that I'm making, could be controversial. I think you will see the highest number of bankruptcies in the next 5 years in solar. The kind of projects that are getting taken up, when I look at the cost in which they are getting serviced, it's not even, the IRRs don't even match your cost of capital. And the reason they are doing it is because everyone wants to just expand capacity and hope they get bought out by someone in the US once they scale capacity. This is not sustainable. And again, power is a regulated asset. So you can't keep increasing the price of an asset just because you produce it. So I think solar is required, but it will also go through a cycle. The cycle that we are in today, I'm not very bullish on solar. So when I say power, I would look at our optimal mix where thermal and coal are a significant part of the mix, because I don't think you are going away. Renewables will supplement this and not just replace the core power. That's how I would position myself.
Thank you for that. And how do you position pharma? And how do you see CDMO in the mix?
So, like I said, in terms of our exposures today, pharma has 5 buckets. One is US generics, second is India API manufacturing, third is CDMO, fourth is hospitals, and fifth is diagnostics. Hospitals we exited late last year. We don't own hospitals predominantly for the valuation and the fact that capex is coming up live in an aggressive way, so your return on capital could drop across the sector. Diagnostics we don't own. What we own and where we are overweight is CDMO, manufacturing on the ground, as well as companies which have 20 to 25% contribution from US generics, because there again you're coming out of a 7-year down cycle, and the rate of change of US generic prices dropping is increasing. What that means, prices are not yet increasing, but the rate of change is. So ideally, we are bullish across the board. We want backward integrated large players. We also have small special situation bets in the pharma space, where that's a bet on the promoter, their R&D, and their manufacturing scale up. But those would be anywhere between 1 to 2% at most. So when you look at our portfolio, you will see a barbelled approach where we have larger weights in some large caps and mid caps, more so large caps, and we have 1 to 2% positioning in certain niche small caps. But our positioning is in the first 3 subsectors of pharma.
Understood, Naveen. Thank you so much for this. Naveen, this is a question related to the portfolio. Within the same sector, for different clients, there will be different businesses. So why is that?
So, for example, what happens is when we like a business. So, for example, I also see someone asking, you are underweight banks, but you own 7% banking and 5% insurance. So, when I speak about financials, I'll answer to both your questions, Ajit. Your first question was, why do we have separate businesses? Some businesses don't flow through into new clients. First, when we think about financials, the lending part of the financials is what we are underweight. We still own insurance businesses. For example, we own 3 businesses. All 3 may not be in every portfolio, but if you look at all our client portfolios, the universe would be 3. All of these 3 have seen the highest growth in their respective sectors. One is ICICI Lombard in the general, SBI Life in life, and Bajaj Finserv as well, where the core driver is insurance, and there that's more of a SOTP play, where the sum of parts looks cheap. So broadly, if you look at it, when I say we are underweight banking, I'm talking about lending part of banking. I'm not talking about insurance. We still have 5.5% weightage in insurance. Second is in terms of names. So, for example, when we started buying IndusInd Bank, that was our largest exposure in banking and still is. Now, we have a certain thesis on IndusInd Bank. Now, when cash is not available, we will not be able to buy across the board. And hence, we buy wherever cash is available. And if suddenly the bank does very well in terms of a stock price and returns become front-ended, there will be 2 things. For newer clients, we will cut down our position size. For example, we were buying IndusInd Bank roughly 3 to 4 quarters back. At that point of time, our starting exposure was 4%. Today, we've stopped buying IndusInd Bank at these valuations. 2 months back, when there was volatility, when we bought IndusInd Bank, it was a 2% position because the bank was up 40% in 3 quarters. What I bought at 4% for original clients, I can't buy the same 4% for new clients at 40% higher unless and until my assumptions on growth continues to be 40% for the next 3 years, which is not. So when there is valuation catch up, Then for newer clients, we may not buy the business. Sometimes we might buy an alternate business and then realign the portfolios, or sometimes we might buy a lower weight. And hence there would be a mild difference. But over time, you will see us renormalizing all of this.
Understood, Naveen. Thank you so much for this. Now, this is a little bit on the macro. Now, with FII flows being negative to India, what is your views on FII flows to the US and other parts of the globe?
See, at the end of the day, I think people need to realize how money flows and not call this. FIIs are coming to India as a part of their broader allocation. And end of the day, they are also humans, which means returns begets flows, and no returns means outflows. Today, just as for us, India is our home market, which is at least when I say us, I mean for ITIS, and I hope it's for every one of the clients on this particular call. So you would invest most of your net worth in equities in India. And it's the same thing for the US. When an US endowment or a pension fund or a Canadian pension fund invest, most of their equity exposure will be in their home markets. The emerging market play is a diversification play for them because the EMs are doing well, India is doing well. So if US is doing well, for them to suddenly say, I'm going to flip my boat and put all my allocation to India will not happen. I don't think that's how they think. There is interest in India, but there is interest from two categories. One, the existing investors have 17%. Today, 17% of the market cap of India is owned by FIIs. The largest it's been is 22. Can it go back? I think it can go back, but will it go back in the next year? I doubt. Maybe it will take 2 to 3 years for it to happen. The second thing, just as we worry about valuation, so do they. They're not going to come in just because the India market gives them returns. They're also going to look at valuations. And many of them believe that people are just going to leave China and come to India. I think people also realize China has been a hard experience for them. But if the metals recover, China could recover too. So incremental money is not going to China. Incremental money is coming to India. But if someone makes the case that people are exiting from China and putting that money to India, I think that argument is not very well thought out because India can't absorb that kind of capital yet. And at the same time, FIs don't think like that. So if you ask me, FIs will come back. I think they may come back later in the year. I told you about the elections number. If everyone cheers for it, they will cheer for it and they might increase their allocation. But is 17 going to 22 in the next 6 months? I don't think so. I think it will take 2.5 years. They will also have to invest, but they don't need to invest in the same flow as DIIs. And I always believe as an economy transitions like we are going through, DIIs will be increasingly relevant. So I personally believe people need to refocus their time and energy on understanding DII flows rather than FII flows. So if I would pivot this question and say, how confident are you for the DII flows to continue? Because that is becoming increasingly more relevant. FIIs will do what they do.
Understood. Thank you, Naveen. Naveen, the final question, it's on a stock-related question. How do you see IEX?
Sure. So I think IEX has gone through a fairly difficult time in the last 5 quarters. Started off from the notice from CERC, and then it went into the regulatory headwinds around coupling. Now, the first results of coupling have come out, and the incremental benefit of coupling, at least in the Indian ecosystem, in terms of reducing prices and tariffs, is not very evident. So now they have asked Power Grid of India to actually create another super exchange and see if the price matching system that they currently implement with another called RTEM. RTEM is a dynamic way of matching power. If these two implemented in tandem can cause any price differential change. And the results should come out. Initial results say it is not very material. So what will they do on the back of this? Will they still go about implementing coupling? Will they basically bring in MBED, which means the volumes on the exchanges can go 10x, is yet to be seen. So there are headwinds because the business is now back to growing at 15% growth. but valuations are not reflecting that because of the headwinds. I personally believe that if they go ahead with coupling, it should be combined with MBED in an environment where there is a power deficit. You don't want to be tampering with an exchange that is clearing prices. So I am cautiously optimistic. I'm not exiting the business. And I still think that that business has upside from a structural perspective. Near term, 3 to 4 months, we would need that the regulatory noises to get cleared for the share price to start tracking what the earnings growth have been, especially in the last 1 year, which is not yet reflected.
Thank you, Naveen, for this. I end the Q&A session. Vidya, over to you. Thank you.
Thank you, Naveen and Ajit, for the interesting updates. Once again, thank you all for the patience on the call. The recording of this webinar will be sent out once it is available. Wish you all a happy weekend.
Thank you, everyone, for your time.
Thank you.